Hi, this is Soman, and in this video we are going to go over the term mortgage. What is mortgage? Let's say in this township we have a house that is for sale, and let's say this is the house, and the current value or the sales price that is for this house is $100,000. Okay, now there is a bank which is interested to lend the money. So bank is going to lend, and there's an interested buyer he's interested to buy this property. So in order to understand what is mortgage, let's put this three things in a empty place where we can discuss on that. We need the property and the two person. Who are they? One is a person and one is the bank, who's the lender. So we have two things. One is the bank, who's the borrower, who is the lender, and a person who's the borrower. So let's draw a person here, and we'll give Joe. The name is, let's say, Joe. Okay, Joe is the person who's interested to buy this property. The price of this property is, let's say, $100,000, and bank said, I'm Joe, I'm ready to give 80% of the value of the property, which is going to be like $80,000. So Joe can borrow 80,000, and Joe can add his another remaining 20%, which is $20,000. So which is 20% of the money, so that he can buy this property. He can go and live in this property. So in this case, bank says to Joe that if I'm ready to give you the money, but I need two documents. One is the mortgage. So Joe has to sign a mortgage. Okay, it is a type of a security. Okay, it is a type of a security. Okay, it says the security is nothing but the house. House is the security for the bank. It says that in the mortgage, when you're signing that, as a like Joe is signing the mortgage, and bank is going to receive the mortgage, it says if Joe default to pay the mortgage, the money that he's lending, and how he's going to pay back, that is the second thing coming. But his bank is saying that if Joe is unable to pay the money he's lending, they're going to foreclose the house, right? That is the security, the mortgage document, it says. So bank is going to get or take the mortgage, okay, from Joe. So in this case, who's the mortgager? Okay, so Joe in this case is the mortgager. So I'll let me write, this is the mortgager. Okay, and who's the mortgagee here? Bank is the mortgagee. Mortgagee, who's the receiving the mortgage, and who's giving the mortgage is the person who's borrowing the money. In this case, Joe is giving the mortgage, and part of this deal is also Joe has to sign a note. Okay, there is a note. It says it's a kind of a bond. Okay, in this note it says the term, okay, that is maybe 4% interest. Okay, so let's say 4% interest he'll be paying for 30 years. Okay, and what will be the calculated market the monthly payment? So that in a different video I'm going to show you how to calculate that. So the note is mainly to say there is a some amount per month you have to pay with the terms of 4% interest for 30 years. That is the note, that is the promissory note that is signing. So Joe has to sign two things. One is the mortgage, and note he's going to give it to bank, and bank in turns is going to give what? The money. That means the bank is going to give $80,000 to buy the house. So now Joe has total how much money? He's having 80,000 from bank he borrowed, okay, 80% of that, and the 20,000 that he's putting as a down payment. So he's going to take this too, and he's going to give towards purchasing the property. That's 100, plus he's going to give the closing cost and all other things. Okay, so these are the so that in a different video I'm going to explain about the whole process of financing and the closing cost, stuff like that. But the term that is the mortgage is explained here in this video. But as part of this, the note, this process of the term that is described, the pledging the property as a security, this is called hypothecation. So let me try. Okay, sorry, this is called hypothecation. Okay, so this process that it's saying that you're going to take the property as a security, but at the same time Joe can live there. He's going to possess, okay, possess into that. He's going to live there. This is going to Joe is going to be the taking the possession of this property, even though this house is used as a security for the bank to lend 80,000. This process is called hypothecation. Okay, this process is called hypothecation. Now what all the terms or the duties of the borrower for making sure that this mortgage is in good shape or it's not going into the default. So the duties that bank wants to see, okay, duties of Joe is going to make sure that they are paying on time, right? Paying the monthly payment, whatever he's going to pay per month, is making that paying on time, right? So this is the first thing, and is making sure, bank want to make sure the property tax, okay, property tax which is paid on time, okay, per yearly, which is yearly or whatever the way Joe wants to pay, but it is yearly tax is paid on time, and make sure the property is maintenance is right. Okay, it is maintenance is proper, so maintenance is there, and also you have to make sure there is no alteration to the no modification, right? No major modification, because what happens is, so in this case what happens is, since this property is the security, right? The currently this is like the price, or this 100,000 is the total value of this house, and if Joe started modifying something that depreciate the value, bank is not going to like accept that, because this is his security. It's the security for the bank. So in case of any default, they wanted to foreclose and make sure that they get back their money, their whatever the money they're lending right now. So this they want to do, so they don't want any major modification to the property. So these are the duties of the lender, in this case Joe, to make sure that they're performing in order to maintain the mortgage. Now what is the duty of the lender or the bank? The bank has to the duty of the bank in this case is they have to record the mortgage. So they have to record the mortgage, this mortgage document. Okay, so what is that means is that it is important that to the local office you have to record this mortgage, so that if the person who's is borrowing the money in Joe is going to go for another second mortgage on the same property, the the other lender can see this particular, there is already a lien. A lien, mortgage is nothing but a type of lien. That lien already exists in this mortgage or against this property. So the second mortgage and other mortgage will be get priority based on the document that is reported or recorded in the office, in the government office. So that is the local authorities should have a record of this mortgage. So that is the job or the duty of the lender to record this one. Now another thing that we have to learn here is that what happens when let's say Joe make the entire payment that he owned, that he borrowed, he paid back everything, and that is called the satisfaction of the mortgage lien. That means whatever the lien, the mortgage lien was there, that was from this particular mortgage, and this is the mortgage is nothing but a mortgage lien that was there attached to this this property from this first lender. So this is this, once it is satisfied, that means paid off completely, like it is called the release of the mortgage. That means this mortgage lien is not going to be there anymore. It is completely taken off, right? So in that case, again, it is the duty of bank to record the mortgage, right? The satisfaction of the mortgage. Record the satisfaction of the mortgage. Okay. Now in that is important, again it is very, very important, because once Joe paid the entire amount that he borrowed, there is no lien against this property anymore. In that case, he can use the property to borrow more other second mortgage or any other things that he can use that property for. Before we end this video, let me also explain what is called a trust deed. Now many bank want to prefer another instrument is called a trust deed or a deed of trust. Now what happens is they want to involve a third person or third party called trustee, okay, who's going to hold the title of the property. So they are going to hold the title of the property as a third person here, as a third party here, okay, and bank is going to continue to get the monthly payment from the borrower, in this case Joe. So Joe is continue to pay, and then is satisfying the terms of the mortgage and the note. So in this case it will continue to, once the satisfaction is the mortgage satisfaction is recorded, the trustee is going to give the title to Joe, and that is the process. But in case of a default, let's say in case Joe unable to pay the payments, then bank or the trustee will give the title to bank, and bank can go ahead and possess the property that Joe owns. So that is much easier than the other way, when this instrument is not used, the trust deed or the deed of trust, or when this instrument is not used, what happens is Joe has to go through the foreclosure process in order to pay the remaining balance, or whatever the money he owns owed, that he has to return to bank. That process is foreclosure, but that's a very lengthier process than going through this trust deed, a deed of trust. So many bank or lender prefer this instrument of deed of trust over the mortgage. Basically, a trusted deed is conveys the real estate as a security for the loan. Okay, and that is pretty much similar to what is a mortgage is. So that is another thing that you have to keep in mind. So I hope you are able to understand what is a mortgage. If you like this video, please subscribe to my channel, so that, and like on Facebook and Twitter. Thank you. Hey, one more thing, actually, I just remember while before ending this one, I just wanted to make sure that in the duties, I actually forgot to mention that one of the duty of the borrower is to make sure they're paying for insurance, because okay, it's important that the property, the property should have a proper insurance, because bank is holding the property as a security, and bank wants to, or the lender wants to make sure the borrower is paying insurance so that if something happens to the property, the insurance is going to pay and make sure that the value of the property is not going to be decreased. So that's why so I just forgot, so I thought it's important to mention that. Okay, go ahead and please subscribe, as I mentioned again, and thank you.